So Marlena, we just finished in the previous part of this conversation talking about the academic findings around premiums and markets and some of those things. Let's talk for a few minutes about maybe more application ideas for clients, or at least things that people maybe think they need to be doing or taking into consideration in how they are managing their portfolio today. There's a lot of talk today about low interest rates. Certainly, there's a lot about inflation in the news and political policy around taxation. How do you think investors should respond to relatively new circumstances in terms of how they allocate their portfolios? I mean, what would cause or indicate that it's time to change an allocation?
That one's a really common question. And the first thing I'll say is we've done a ton of work on the relation of interest rates, inflation rates, whether it's levels or changes, all of these things, and whether it can help you market time, either stocks or any of these premiums like the size premium or value premium. And the answer has always come back, it's not really a great market timing tool. So let's put aside any kind of market timing strategies. And then more from a strategic point of view, the way I think of asset allocation, how it gets developed is it's that trade-off between how much outperformance do I, kind of want to pursue relative to how much underperformance might I be willing to tolerate, or how much volatility. And it all should go hand in hand with a long-term financial plan. And because of that, I think of asset allocation changes as needing to be very rare. Typically, it's when either your personal circumstances change as opposed to you have a change in the marketplace. So, for example, if your financial plan changes or how much you expect to need in retirement, for example, that's a good time to check in with your asset allocation to make sure it still meets your long-term investing needs. Another time might be if you discover something about yourself. So it's really easy to think about that trade-off that we mentioned earlier of, well, I want to pursue higher expected returns, and I think that I can tolerate a lot of underperformance and look really different than the market. Well, then you go through a period where you actually live through that underperformance and you find that maybe you are not so tolerant of it as what you had thought when it was a theoretical exercise or a hypothetical one. So that's an example where, maybe you learn something about yourself and your own risk tolerance, in which case maybe that investor would want to dial it back. But again, all of those types of changes, I would view more from it's almost all permanent changes. Nothing's ever permanent, but a long-term change as opposed to I'm going to make this asset allocation change until I see this particular market signal, and then I'm going to go back. Those are really difficult to do successfully, only because any kind of market timing or asset allocation timing decision requires two correct decisions, right? When to get in, when to get out. And it's really hard. So again, any kind of asset allocation changes generally, I think, are due to either personal circumstance changes or discovering something about your own risk tolerance.
I think it's a good reminder. I mean, patience is always hard. When things are happening around us, there's lots of news. The news is very loud. Newscasters need to get people's attention. So of course they're trying to make a case for it. This is a significant event or something's happening. And that makes it feel like, well, I should be doing something. When really, and a lot of times, and we totally agree that the financial plan drives the portfolio. And if we're committed to kind of the long-term story of how markets work, then it really is the financial circumstances of the investor, or maybe like you said, they discover something about how they really feel about risk or how they experience risk. That's the thing that's most important in structuring that portfolio. I mean, we have good information to create a highly diversified global portfolio, exposed to some maybe premiums to try as much as the investor can kind of stomach to look different from the market and higher expected returns. But overall, those personal circumstances are the things that drive the day-to-day portfolio decisions. And hopefully they're not day-to-day. Hopefully things, remain relatively constant over a longer period of time. So they can be patient and pick up the premiums. We talk about those premiums as you must be present to win. kind of a thing because they don't appear all the time. So that's a great answer, really important.
That's right. One thing I would point out, though, Kent, is that even though from a overall picture, stuff should be static and not changing, that when you drill down, stuff does change every day. So that might be good for investors to realize is, hey, like at least at Dimensional, we're looking at the portfolios every day. And for example, if you're focused on value stocks, what is a value stock might change every day. So there is activity, but it's certainly not something that you need to do at a really aggregate level. It's something that the market almost does for you every day because prices are moving. And if you're paying attention to them, then we kind of rebalance the subcomponents every day. So there's a slight difference there. It's so nobody should feel like it's a complete set and forget. We've got our eyes on them.
Yeah. No, that's good. And that would be a subject for another conversation. Just what sometimes can appear static on the surface. If it's done well, it's really not static underneath. So rebalancing is a great example. As markets move at different times, sometimes a market will become more and more expensive and become out of balance. If it outperforms, now there's more of that in my portfolio than I intended. I've got a kind of a risk overweight to one asset class. And so we rebalance back to those target allocations. Same thing's happening within the funds that Dimensional manages. You're watching the security weights and what's happening, the valuation measures. So there's a lot of activity. It's just sometimes I think for investors especially, there's a sense of, should I be doing something right now? They want to, we all want to have our hands on the wheel because we think, well, if I'm doing something, I'm in control. And maybe, trying to turn the wheel too hard creates problems.
Yeah.
Especially not doing, like you said, in the market timing kinds of, hey, I think now's the time to fill in the blank there.
Yeah. Not doing something is also a decision. Sometimes it's the hardest one.
Yeah. Heard that many times. Hey, so let's change gears here again. Foster Group, we recently recorded a financial perspectives on ESG investing, environmental, social, and governance investing. Seems like there's a lot of interest, certainly a lot of different ways to do that right now. And because it's a relatively new area for investors to think about, I think there's just some uncertainty as well. What does this mean? And are there any benefits to investing in an ESG portfolio? So from your point of view, I'm just curious, what are the additional risks, if any, that an investor should be aware of in implementing an ESG type portfolio?
Yeah, I think that starting off with just that ESG is a pretty broad range of potential portfolios. So ESG stands for environmental, social, and governance. And there's a whole host of different considerations or approaches that you can take in any of those, E, S, or G. And so because there's a lack of consensus about what ESG even means, starting with a really clear view of what you would want from an ESG portfolio is actually really important. So, for example, on the environmental side, you probably don't want to pay attention to 80 different environmental variables because first, the data quality might not be very good across those. Some of them might just not be that important for what you care about around the environment. So just one example, when we look at our sustainability or what is important from a sustainability perspective, really top of mind is climate change, in which case that now points to a concrete way of mitigating or reducing the exposure to the companies that are the primary reasons for climate change, or at least carbon is certainly one of those really important components. Whereas, something like recycling might also be important for the environment, but at least as in terms of the magnitude of importance may not be as big as carbon emissions. So understanding what you want out of an ESG portfolio is actually really important, mainly because if you whittle down a portfolio to take into account every single possible thing, all of a sudden you've given a lot of diversification up.
Mm.
Or alternatively, some portfolios might actually pursue a certain type of company, right? A company that has a certain business line, or they're basically, really wanting to focus on a particular type of company that may they expect to have good results in a certain outcome in the future. Those things are, I'd say, is one area where you may be incorporating additional risks. If you kind of throw out key investment principles like this idea of diversification. So that's why it's really important to be really concise about what is it that you care about in this ESG space, and then have a portfolio that's designed to address it. And hopefully is one where you can actually see some measurable outcomes. Because while there are some goals that from a societal point of view are, really wonderful to consider, from an investment data perspective, might not actually be feasible to implement well in a portfolio. So these are the types of things that I would strongly advise, clients to consider, and just recognize that investing in a company is only one tool in the toolkit, so to speak, that we all have, that there are multiple ways to address something like climate change, for example, our consumer behavior, regulatory laws. All of those things are probably going to come together. And honestly, the impact from, ESG investing might not be as big as what some would say are going to be key things like regulation. So just some things to consider when evaluating an ESG portfolio.
So one of the stories, and I use the word story as a narrative, one of the stories or narratives out there is that there might be a positive premium associated with this ESG style investing, because if the companies themselves are doing this kind of positive behavior, let's say, whatever it might be, that those companies will find more favor both in the marketplace for maybe what they do, but also they'll find more favor with investors who like what they're doing. And so because of that there may be a positive premium associated with companies that have a positive ESG score or relationship to the market in some way. How would you answer that idea of whether there's a positive premium associated with ESG style investing?
Yeah, I think it's just that it's a story. It's a story without a lot of either theoretical or empirical support. So when you think about I'll just focus on the E in ESG, although the statement kind of broadly applies. Yep. That a company's ESG profile or their emissions or their engagement in certain business lines that consumers might like or find attractive, all of those things they're not particularly new. There are potential risks associated with climate change, and they're uncertain. But financial markets have been dealing with lots of different types of risks and uncertainty about those risks for a very long time. So while the attention on climate change is certainly growing, and a lot of these other ESG issues is growing, they're in the public domain. So our view is that they are priced, meaning that if you think that a company is attractive on an ESG measure, then that information is already embedded in that stock's price. So if you're paying attention to drivers of return like prices, like is it a low price or a high price stock, then that already tells you about that stock's return. Some of that stock's return may be driven by their ESG considerations, but the key point is that it's subsumed by its market price. So looking at something like ESG is not going to be additive and help you identify companies with even higher expected returns. And even if you just think about the goal of ESG investing, if you envision that investors want to invest in greener companies, then what would that do? It would drive up their price and it would lower their discount rates, implying actually a lower expected returns. So what we actually see in the data is that you can't really tell much of a difference between, for example, a portfolio that is constructed in a very similar way, but one has some ESG overlays on top. The expected the historical returns on those two portfolios are actually very similar, which just suggests that focus or focusing on greener companies doesn't lead you to focus or like exclude from your portfolio just those highest expected return securities. So if anything, what the theory suggests is that you should expect lower returns. In terms of the data, you don't actually see that. So that could be because the level of interest in ESG today is not sufficient to really shift their expected return profile. But overall, I mean, I kind of think of it as just another piece of information that that financial markets have been dealing with lots of uncertainty, lots of different things that could impact the outcome of companies. And they've been doing that for a very long time. So I don't really see any reason why ESG risks are going to be different than other types of risks that companies may be exposed to. So overall, I think that there's reasons why investors might choose an ESG or sustainability or social portfolio in order to align how they invest with their values. But we would argue that pursuing higher expected returns is not necessarily should not be the primary reason for investing in these.
I like that. I think that goes back to a message that I've heard from you and from Dimensional for a long time, that there's so much information already in the price today. All these concerns, whether it's the company's financial health, whether it's the things they're doing on an ESG basis, whether it's their management level, the expectations for a sector or a region or whatever it might be, it's not like that information isn't out there and being incorporated into prices today. And these ESG factors really are just another example of a kind of a factor, piece of information that is incorporated in today's prices. That's always been a very helpful concept. I think it's a hard one sometimes for investors to keep in mind, because there seems to be information come out and we think, oh, I need to act on that information because next year, as a result of this information, this is going to happen. As though everybody else investing isn't already putting that into the price. That expectation is already there, even as the information is just barely coming out. We want to think we can get ahead in somehow and predicting the future. So appreciate that. I do agree, though. I think there's a lot of clients who they look at that ESG approach and they find it attractive for some, expressing personal values, being invested in a way that they feel good about. The nice thing is with today's tools, they can have a highly diversified portfolio and express some of those ESG preferences and still, I think, have a relatively good opportunity to get decent performance if the portfolio, again, is well diversified and constructed according to some of these other principles we've been talking about.
Yeah, I think it's important to distinguish between just because we would say something is priced and therefore you shouldn't react in your portfolio. It's not to say it's not important, right? Like, I think that lots of scientists would agree climate change is very important. It's just that it doesn't lead to a change in your portfolio only because everybody sees it. It's just like COVID, for example. If you think about March and we were going into this, a hugely uncertain period, and it's obviously had huge ramifications globally, but didn't actually mean that you should sell out of your investments. In fact, if you look at the stock return since last March, it's had a huge run up. So just that disconnect, I think, is really hard to logically grasp. And it's because we're not at all saying that by not reacting in your portfolio, that means it's not important. There's hugely important things happening in the world all the time. Yeah. But you still shouldn't react in your portfolio because the market's already incorporated that information.
Yeah, that's a good word. All right. So this is a part that I like. I get some closing questions here that are a little less technical, and just ask you some questions about your experience. So the first question, and I mentioned this to you before, so I'm thinking you're prepared. But what are some of the most interesting experiences you've had as an investor or a researcher? I mean, what's an example of something that has really surprised you?
Yeah, I can think of two recent examples. So first was that return through the global pandemic. I mean, that has to be surprising to most people. But then the second one that's also recent are these meme stocks. I don't get them, like the GameStop, the AMC. Those ones they're just interesting to watch. And I do say interesting to watch because I would not recommend that you take financial advice from Reddit. But it's interesting. There's not really an academic framework for studying those.
That's the good one. There's not an academic framework. I like that. It's like, this feels crazy, and maybe it is.
It feels crazy.
Yeah. Maybe it is. So you mentioned Reddit there briefly, but not Reddit, but what news sources do you read or listen to for information?
So, I mostly read the Wall Street Journal. And outside of that, sometimes I read a few academic blogs because I am inherently a nerd at heart. And then listen to, I'm a big podcast advocate. So I like to go for walks or do gardening while listening to podcasts. And usually they're not about investing though. I like to listen to, my two favorite ones are Radiolab and Hidden Brain. So I like kind of like pop psychology stuff and sciencey stuff.
Yeah. I think you learn that the Hidden Brain, Shankar has some great guests on there talking about different things. So I like that one as well. Yeah. Okay, last question here. If someone asks you for a book or a publication recommendation to better understand just investing in general, they're just getting started. They want to understand broadly what am I getting into here as an investor? Where would you point them?
I mean, I think I would point them to you, Kent. Talk to your advisor. Because honestly, when it comes to a lot of the investing things, it seems like the more you know, the more tempted you are to do something. And the more you do in your portfolio, generally, I think the more chance to make a bad decision. So, I mean, the books that I read about investing were all from grad school. I don't actually read any non-academic things about investing. So I probably wouldn't be the best to make that recommendation. Talk to your advisor is what I'd say.
Fair answer. That's good. We have a list that we like around here. We can share that with people as they're interested. But, actually a lot of the ones that we recommend, they do roll back to this investor behavior. Understanding ourselves as an investor so that when you have a reasonably constructed portfolio, you want to understand how you're going to feel along the way and the temptations that are going to maybe come to bear on why you would want to desert something that you have thought through and makes sense with your plan. But in the moment, it feels very hard to hold. One of my favorite book titles is Winning the Loser's Game.
Okay.
It's a great title of a book where they talk about in tennis, people who try to hit winners, if they're not great players, when you try to hit a winner too often, you end up hitting the ball out more than you hit it in. So to win the loser's game is just to hit the ball back to the other person and let them make the mistake, which I kind of like that idea of, that's an interesting, as opposed to trying to take gambles to win. It's like, no, keep the ball in play, stay invested, keep the ball in play, and good things can happen. So that's
a good one, actually, because there are a lot. It's what I like about Hidden Brain, actually, is it's not really about investing, but there's a lot about just the mistakes that you might make if you let your emotions or just your biases kind of rule your decision making. Yeah. So that's a good one. I don't have any investment ones, but I do like that stuff. There's a lot. There's a lot in there.
There is a lot out there. Yes. So, well, hey, Marlena, I've always come away from our conversations with the sense that I've learned some important things. Today's no different. I get my curiosity piqued, things that I wish I knew, maybe that I can't know. But anyway, I think we could keep this conversation. I could keep it going for a long time. It would be too long for you, too long for other people. I know that. So we'll stop today, but I so appreciate your time today and entertaining some questions from us. just thank you too to your associates at Dimensional for being valuable partners to Foster Group for a lot of years. We've been working with Dimensional really since the late 1990s, and it's been an important partnership for our firm. We've learned a lot about investing in markets through our partnership with Dimensional. And for those of you watching, thank you for giving us some of your time today. As always, if you'd like to talk with a Foster Group advisor about your personal situation, you can reach us at any of the information on the screen you'll see here in a little bit. We'd love to sit down and have a conversation about your personal circumstances and see if we can't be of help. If you just have some questions, please let us know. Also, if there's some things you'd like us to talk about on financial perspectives, we'd welcome your input there as well. Marlena, thanks again for a great conversation, and I'll look forward to seeing you soon in Austin.
Thanks for having me.